good afternoon, depending on where you are. Thank you so much for joining us today. This webinar is a really unique opportunity for us to all come together and discuss what we can be doing together with on the issue of banks and climate. We have a group of people who are prepared to speak to you today, and I'm going to turn it over to them in a minute. I just want to introduce myself and give you a few pointers about what's going to be happening on the technology side. My name is Erin Gorman, and I am the director for the Center for Sustainability Solutions at Green America, where the Climate Safe Lending Network is housed. This webinar is brought to you as a collaboration of that work. The goal of the Climate Safe Lending Network is by 2025, European and North American bank lending is consistent with staying well below a 2-degree global temperature rise. And like I said, the topic of this webinar is focused on shareholder and bank engagement. The speakers are going to do their presentation, and at the end, you will have an opportunity to ask questions. There is a button that you will see when you click that says to raise your hand to be called on, or you can also type a question into the chat. This webinar is being recorded and will be shared with all the registrants afterwards. So at this point, I'm going to hand over to Christina Herman from ICCR to welcome you.
Good afternoon. Thanks everyone for joining us. My name is Christina Herman, and I coordinate the investor campaigns on the climate crisis within ICCR, the Interfaith Center on Corporate Responsibility. For those of you unfamiliar with us, ICCR is a coalition of faith and values-based institutional investors in the United States that has engaged Fortune 500 companies on human rights and sustainability issues for nearly 50 years. So aware of the critical role of the financial sector in the transition to a just and clean energy economy, ICCR joined the Climate Safe Lending Network last year, building on the engagement work done by several of our members with the banking sector on climate risk. You'll hear from them in the course of this webinar. From that, a core group of ICCR members, using the analysis supplied by NGOs in their report, Banking on Climate, pledged to work with the largest banks to encourage a shift in focus from an assessment of climate risk to the institution to measurement of the risk those institutions are creating for the larger society. This webinar kicks off an opening up of that work to broader collaboration with interested investors. And we would welcome the participation of anyone on this webinar in this work with banks on Paris alignment, and look forward to discussing it. So without further ado, we can move on. Thank you. I think Jason is up next.
Jason, can you hear us?
Yes, sorry.
Okay, great.
I was on mute. All of us, I think, are getting used to working from home and remote technology. Jason, so my name is Jason Disterhoft from Rainforest Action Network. I'm on the climate and energy team and am involved there with bank engagement and research. So what I wanted to do was offer just a quick run through of top-line findings from the latest edition of our annual report, Banking on Climate Change, that Rainforest Action Network puts out with a number of other NGOs. And this just came out yesterday, so these are new findings, sort of hot off the press. So Banking on Climate Change does two main things. First, it builds league tables looking at lending and underwriting from 35 global banks to the fossil fuel industry as a whole. That's the first thing, and then other particular slices of the fossil fuel industry. The report also analyzes future-facing bank fossil fuel policies. I'll be focusing on the first of those today, but we'll also say a bit about the second, and then other folks on this webinar will be saying quite a bit more about what banks are doing. Again, the metric that we focus on in building these league tables is lending and underwriting to fossil fuel companies, and figures are adjusted down based on the fossil intensity of the borrower or issuer in question. And the 35 global banks are the biggest banks that you would expect to find. You know, not from the top 20, all of the private banks in the top 20 global banks, and then a number of other regionally important players. So the top line here is those 35 global banks finance fossil fuels with $2.7 trillion since Paris. And that financing number has increased each year since Paris, and that was true in 2019 as well as each of the previous years. At this rate, fossil financing will hit $1 trillion a year by 2030. That's exactly the wrong direction. Next slide, please. So who are the banks who are most responsible for this lending and underwriting? Here are the top 12. JP Morgan Chase really jumps out here. Not only are they number one, they are number one by a huge margin at this point, by a 36% margin above Wells Fargo in second place. That is an increase in that margin from a year ago. That's not due to anything that JP Morgan Chase is doing particularly worse. It's more because Wells Fargo did have a significant dip in 2019. But yeah, JP Morgan Chase is basically flat, a slight increase over the course of 2016 to 2019. Next slide, please. And in fact, the top four fossil banks are all based in the US. JP Morgan Chase, Wells Fargo, Citi, and Bank of America in that order. Those banks are responsible for 30% of the fossil financing since Paris. Bank of America had the biggest increase in fossil financing of any bank in the scope of the report from 2018 to 2019 at about a $13 billion jump. And Citi had the fifth biggest increase. Both of them are on track for a quite significant increase, just extrapolating from the 4 years in this data set. And these top four are on track for an 83% increase by 2030. Looking outside the top four, the next three, 5 through 7, each are a regional worst bank. So RBC at number 5 is the worst in Canada, again by a very significant margin over TD, 36%. MUFG is the worst in Japan. Barclays is the worst in Europe by a little more than 36%. And looking a little further down, one other bank just to mention is BNP, just outside the top 12, and they're the worst in France by a 56% margin, which is quite striking. So those are the numbers in terms of lending and underwriting to the fossil fuel industry as a whole, about 2,100 companies. The report also builds league tables for lending and underwriting to particular slices of the fossil fuel industry. And those are listed here on this slide. So the first of those is expansion of fossil fuels. We have a list that we built in collaboration with Oil Change International and Ergewald to identify 100 top companies across the oil, gas, and coal sectors that are doing the most to expand fossil fuels, and then looked at the bank financing for those 100 companies. JP Morgan Chase, again, is number 1, followed by Citi, Bank of America, and Wells Fargo. So same top 4. And financing for those 100 companies is at almost $1 trillion, so more than a third. And then looking at some of the other key subsectors, across oil and gas, and then in coal mining. One thing that really jumps out is JP Morgan Chase, not only the #1 overall fossil bank in the world, but either #1 or the runner-up or the #1 in the U.S. For especially in oil and gas, some of these key subsectors. On tar sands oil, actually their figures in relation to other U.S. banks are really striking. Significantly more financing since Paris for tar sands than the other big five U.S. banks combined. Go to the next slide, please. One other bank, just to flag in these these subsector findings, is Citi. Again, sort of the runner-up in a few key oil and gas subsectors, and in the top 5 for a couple of others. On coal power, they are the biggest coal power bank outside of China, and the biggest in the US by a significant margin over the #2 bank. Next slide, please. So as I mentioned, the other main thing that the report does is analyzes future-facing bank fossil fuel policies. So we look at, is a bank, does it have on paper future-facing hard restrictions on #1, expansion of fossil fuels, whether that's restrictions on projects in a particular area or restrictions on corporate finance for companies that are expanding a particular area. And #2, does the bank have commitments either to phase out or exclude companies in a particular fossil area? And this year we switched over to a point-based system. So out of 200 points, we now have, we're able to score those future-facing fossil restriction policies. The brown bar you see here is the coal policy. The red bar is oil and gas. So Crédit Agricole under this system grades out the best, largely on the strength of their world-class coal policy. And then you see a sort of second tier of other European banks just below that. Another thing to note here is with the new Arctic and coal policies from Goldman Sachs and then JP Morgan Chase just in the last few months, those banks have moved into the top 15. Previously, there was really a huge gap, and that gap is narrowing a bit between the US and European banks. So just to mention what that Crédit Agricole policy looks like, so ending financing for companies, expanding coal power operations, calling on clients to have coal exit plans by 2030 or 2040, and then excluding companies above 25%. So really a strong policy and a model, and something that we need to see not just for coal, but for all fossil fuels. And then the last slide, if you would. And just to say, this is rough. I think this is a representation of the calls to banks that are coming, sort of emerging from the climate movement, emerging from the NGO community. So the overall goal, and I think everyone would agree with this, but aligning bank policies and practices with a world in which climate change is kept to 1.5 and human rights are fully respected. And we see the immediate steps, we see the path forward in 3 parts. So #1, no expansion, stop financing expansion of fossil fuels, whether that's via projects or companies that are expanding fossil fuels. #2, commit to 1.5 aligned phase out. And #3, this should go without saying, but it needs saying, stop financing projects and companies that are associated with rights abuses. So that's, it's just a whistle-stop tour of the new report just out yesterday, and would be happy to engage either here or or offline about more specifics. Thanks, everyone.
Lauren?
This is Lauren. Can you hear me?
Yes.
Okay, great, thanks. Delighted to be on today's webinar, and I'm going to walk through some of the findings of our fifth report on analyzing 50 banks globally on what they're doing along three kind of core metrics or core issues: climate strategy, risk assessment, opportunities. In addition, we have done some differentiation amongst the banks regionally, but I'll focus primarily on the US and Europe. I wanted to say that one of the overarching conclusions of our report was that while there's been an explosion of tools and frameworks focused on scenario and climate risk disclosure, this has really not led to the transformative change we need to see. Through Climate Safe Lending Network and through other forums, we really need to move conversation and action from climate risk to climate impacts. We have been encouraged to see in late 2019 and early 2020, some companies in Europe like RBS and Lloyd's talk about alignment with the Paris goals, but I think the devil's in the details. And one specific metric one of the participants asked about was, how do you look at alignment? And one of the specific metrics we actually looked at was whether or not the banks had adopted explicit 1.5 or well below degrees Celsius target in their risk assessment and sector level criteria for carbon intensive sectors. I can talk about the details of the Lloyd and the RBS goals in particular a little later on. But one of the things I will highlight, there are organizations like the Principles for Responsible Banking, for example, which represent a third of the global banking sector, which also have publicly committed to alignment. And we need to not only support those banks, ask other banks to join, but also put rigor into the process. Boston Common has been part of the Climate Safe Lending Initiative, supporting innovative interventions around the need for banks to move quickly on this. And I've been particularly happy to see us doing things like workshops and peer-to-peer learning models, which has changed some of the bankers' perspective and ability to enable change in organizations over the last 12 months. We ourselves at Boston Common are also supportive of PCAF, the Platform for Carbon Accounting Financials, and actually are the first US asset manager to join that in early 2020. And it's actually one of the key taxonomies or methodologies we're asking the banks to move on. I wanted to highlight a little bit more under the three different metrics. Yes, thanks. On climate strategy, I think what's really important to note that we've been asking this metric around adopting a group-wide climate strategy for the last 5 years. We're still only at 2/3, and we saw very minimal improvement across the 58 banks globally. On the underlying metrics, you can go to the next page. On a regional level, if you look at the differentiation on some of the metrics we've been focusing on, we've actually included, since the beginning, a look at not only participation in industry initiatives or trade association engagement, we've also looked at kind of all of the lobbying activities. And in particular, in 2019, we started to look at whether or not the companies are using their voice and influence with trade associations on progressive climate policy. We are pleased to see, if you look at the European, which is the pink highlight, you see 100% of the European banks, those 20 banks we've covered, involved in industry initiatives and knowledge sharing. And we see also broad involvement with the US banks. Where you see striking differentiation, though, is really when you look at engaging trade associations on progressive climate policies. You see almost 90% of the 20 banks engaging and using their influence with those trade associations versus only 9. Go to the next slide. I wanted to also, we've had a strategy of focusing on both the risk side and the opportunity side. And I think here, if you look at, we've actually seen very little improvement with one of our core metrics, which is adopting explicit targets and metrics around the opportunity set to promote clean and green. Though we've seen many more announcements recently, including Goldman Sachs coming out with a 750 billion commitments. What should concern investors on this call and others is that we don't really understand what percentage of this overall financing it is, whether it's net new or just recoding underneath a new sustainability label. And increases in clean and green financing don't necessarily mean a correlating decrease in gray financing associated with fossil fuels or other carbon-intensive sectors. What strikes me here on a regional front, we can go to the next slide, is that 100% of the Europeans have adopted certification or accreditation, like the Green Bond Principles, for example, for their clean and green or sustainable financing, versus only 64% for the US. I think this has been helped, especially, but more focus needs to be on the bottom, the bottom metric, which is publicly defining what low carbon or green product standards they're using and what internal definition they're using. I do think this will be helped by emerging taxonomies in Europe and the UK, and we need this in the US. Next slide. So risk management, this is where it really, where kind of the rubber hits the road and where you actually start to really see differentiation between the European banks and the US banks. Jason at Rainforest focused primarily on fossil fuels. So what I wanted to focus on was the real agri practices related to deforestation, where, for example, if you want to go to the next slide, only 1/3 of the European and Australian banks, for example, require no deforestation policies for their clients. Banks really need to ramp up action and expand focus beyond palm oil to other commodities, which has actually been a concerted focus for investors under PRI and series. We need to have banks really looking at soy, cattle, and timber beyond palm. And we really would like to see banks adopt holistic requirements for all soft commodities. And there is an initiative called the Soft Commodities Compact, which hasn't really seen much traction. And the other, if you go back to the previous slide, Erin, sorry, what I want really you to focus on are those 3 bottom indicators. We've already talked about less than 20% require clients to commit to a no deforestation policy. Even less require clients to adopt time-bound certification plans. And then this really brings kind of clarity and visibility on internal structure and client engagement. Only 12% are asking high carbon sector clients to adopt TCFD guidance. We've actually tracked the metric looking at how companies themselves, how the banks themselves are adopting TCFD, how they are engaging clients, and actually now 50% of the banks surveyed are engaging clients on TCFD disclosure, but only 12% are actually requiring them as part of their financing commitments. And I think that this is actually a huge area that we as investors and other stakeholders should really focus on. If we are trying to use TCFD and make it have impact, this is where we need to focus some of our internal engagement with the banks, along with adopting Paris-aligned strategies. You can go back to the next slide. I think I've already talked about the regional differentiation, so I think we could probably move to the call to action. I think similar to the ideas that the climate safe lending will put out, our call to action at the end of the report, which is actually the agenda we've brought into a number of engagements we've had since the report was released, was that we really need to look at transforming corporate culture and mindset, which is an area that the network has focused on, changing financing priorities and procedures, especially related to no new fossil fuel expansion and even looking at restrictions. Go to the last, sorry, could you go back to the last slide? The last slide of the presentation. And
Yes,
maybe just in conclusion, I'll say that, you know, we need to focus on measuring, right, climate risk and climate impact, report out to investors and others, and actually align and reward, you know, for changes in the transition and realignment of financing to be positive, climate positive. And I'll stop there. And so finally, I do think it's important for us to also ensure that there is alignment in corporate voice and bank voice around how they speak about climate, and then how their trade associations also speak about climate. I'll stop there.
Hi, this is Ivan Frishberg. I'm the Director of Impact Policy with Amalgamated Bank. We are a publicly traded bank. We have been around for about 100 years and are a very values aligned and mission focused bank from our start as being founded by a labor union to this day, where we're the United States' largest B Corp bank. Our role in this climate work is to stay off of Jason's list, stay off of Lauren's surveys, but all more importantly, to use our position as a bank to think about modeling and leading on the kinds of policies that we think will really make a difference. I think the reality for looking at the banking sector is that if the banks continue to do what Jason is documenting in terms of funding for fossil fuel expansion and continued activity, then all of our assets as investors and as a bank where we're managing our clients' deposits, they all become risk. And so this is where we have I think a fundamental responsibility if we want to avoid catastrophic climate change in flattening the financed emissions curve. And it's because obviously you all have seen these charts for decades now on emissions, and here we are talking about, and even people like Vice President Pence talking about science and flattening the curve with respect to COVID-19. But this is a very a good example of what we need to do on climate. Go to the next slide. We, as part of the Climate Safe Lending Network, and I'm really just sort of using the pathway for action on climate that has been the focus of focus of conversation within the network, came up with a set of basic actions that we think are at the core of what banks should be doing. And this is not in any particular order, but it is a sort of logical sequence of actions. First, assessing risk within your own portfolio, that is risk to investors and transactional risk to the institution. The second thing, the most obvious thing for us is to end fossil fuel finance. At this point, any finance of expansion of fossil fuels is outside of a science-based target. Ultimately, measuring and disclosing financed emissions, so you can't manage what you don't measure. And right now, very, very few banks, none of the banks on Jason's list are comprehensively measuring financed emissions. And then finally, decarbonizing your balance sheet, and we think that needs to be validated by the Science Based Targets Initiative, which I know a lot of investors have been active on. And then we know to sort of reach the outer ends of the chart and what we need to do in terms of flattening the curve, that it can't just be avoiding bad things, but we actually need to massively increase sequestration and drawdown finance in addition to avoided emission. Go to the next slide. So to get into the nitty gritty of sort of the specific programs and asks for banks, and I want to, before I go through these, sort of reflect on both Jason's presentation and Lauren's. Lauren presented that 100% of the banks, essentially, almost exclusively in all geographic regions, are participating in initiatives around climate finance. There's a lot of adoption of joining initiatives. There are many initiatives. There are a lot of banks who are starting to take policies under consideration or set policies. The challenge is, though, that is obviously completely at odds with what Jason is finding out, which is we are continuing to ramp up our fossil fuel financing each and every year since the Paris Climate Agreement. So one thing as an investor engaging with banks to be very wary of is what they say they're doing or the policies that they can put in place and whether that actually leads to a change in behavior. And we look at things like TCFD, which have been, I think, critical, particularly in the corporate sector, at helping investors understand the climate risk inside a corporation. But within the banking sector, it really has not led to any measurable change in their analysis of different sectors, their change in pricing, or their or exclusions. So there's a big difference between what they can say and what they can put into impact in terms of policy, what they actually do. In that context, the initiatives that we've really been focused on as a bank and working with other financial institutions on are a core set of programs that will really bring about alignment with the Paris Climate Agreement. We think the first of these is measuring, and that's why we've been helping to lead the platform for carbon accounting financials, which is a system based on the greenhouse gas protocols for measuring across all asset classes financed emissions from your portfolio. So that is, if you are thinking about the protocols, it's scope 3 and it's number 15 and the definitions of scope 3 emissions. But for banks and for asset owners, those are the emissions that they need to measure. Just measuring scope 1 and 2 is absolutely not sufficient. Once you've measured those financed emissions, then you obviously can start to do the rest of the body of work that is important. The first thing is to report that publicly. CDP is obviously the place to do that, and they've now incorporated financed emissions as a core part of their new survey for the financial sector. So as banks start to fill that out over the next few months and you start to see those published thereafter, you're going to start to see a real, a big impact on that work. The second is then target setting. That really, once you know what's in your portfolio, and it is, try to speak up, once you know what's in your portfolio and you can take essentially what Jason reported as dollars and turn that into actual greenhouse gas emissions, and you can understand that by asset class, you can understand it by region and by loan product, then you can start the business of managing those products and taking action on climate and then starting to set targets. We believe that those targets need to be validated by the Science Based Targets Initiative, led by WRI, WWF, CDP, and UN Global Compact. That initiative is very close to having a process for science-based targets within the financial sector to be validated, and hope to launch that within the next couple months. A lot of banks have been starting to participate in road testing and modeling and coming up with the rules of how that is done. But we see, and SBTI sort of has been working with us to sort of have a pretty streamlined process from carbon accounting, PCAF, to CDP disclosure, and then target setting validation under SBTI. So all of these things start with the kind of fundamental of, for us, so you have to measure what you're going to do first. Go to the next slide. Just to sort of drive this point home around PCAF, we really think, and the larger banks, the ones that are in Jason's report and the big 6 US banks, nobody at this point is fully measuring their financed emissions. They might be doing some asset classes behind closed doors, but I can tell you from all of our direct conversations, they're still just figuring out whether and how and when to do that. I think they all see that financed emissions is on the horizon, but they're very, very, very slow in getting there. Once they get there, understanding what's the kind of carbon consequence of your portfolio strengthens your ability to do real risk assessment through TCFD. You're going to come out a lot stronger in terms of your disclosures with CDP, and you have the fundamental information that you need to be able to go to be able to set science-based targets. So those are, I think, the core things is that we're working on as a bank with other banks, both here in the US and globally. PCAF has been set up as a bank-led initiative with a fully transparent methodology to allow banks and investors to measure the financed emissions that they have. And we are pushing very strongly for the big banks to get on board so that we can start to see less of a dissonance between what they say and what they do according to the RAND report. The last piece I will say, just to wrap up, is in the context for this is a policy context. TCFD is in the process of being upgraded and ensuring that impact is a material function of risk. As we head into the COP at the end of the year, that will be mandatory. TCFD is clearly sort of one of the things being considered for the agenda. So there is clearly a global context now for banks that are part of TCFD to understand there's going to be an obligation to measure impact that is required to be done under the principles of responsible banking, and that countries will be asked to make that whole framework mandatory. There is already a House bill that would do this. There's already a lot of conversations in the regulator community, assuming that there is a change of US leadership about how that would happen. And so I think the scope here is that this is the direction that we're going, and part of what we're trying to do is make sure that there is a globally harmonized set of expectations and systems for measuring, disclosing, and aligning with the Paris Climate Agreement. Danielle.
All right, good morning. Can you hear me now?
Yes.
Excellent. Thank you, Ivan. My name is Danielle Fugere, and I'm president of You Sow, a group that represents shareholders in engaging with companies to address critical issues from climate change to ocean plastics to diversity, just to name a few issues. Next slide, please. Investor expectations as to banks and climate change have begun to take shape. Although our attention was originally focused on oil and gas companies and utilities, the role of banks in successfully arresting climate change has become more and more clear to shareholders. For better or for worse, as systemically important actors, large global banks will influence whether or not Paris goals are met. Companies take their cues from banks. Restricted funding signals that companies will need to move in new, lower carbon directions. On the other hand, if the banking sector continues business as usual lending, the job of moving energy and other critical sectors towards low carbon business plans is much more difficult. perhaps requiring government intervention. Investors believe it would be better for individual banks and companies to evolve their own plans to meet Paris goals, but such action has to be significant and timely. Unfortunately, as noted by previous speakers, although some banks are moving in the right direction, there remains a huge gap between shareholder expectations and the sector's financing activities. And that gap is growing, not declining, which should really shake all investors to the core. We believe these banks must change their ways in order to have any hope of maintaining global temperatures beyond catastrophic levels. Next slide. Thus, we have filed a number of proposals with US banks this year, and that includes proposals with JP Morgan Chase, Wells Fargo, Bank of America, Goldman Sachs, and Morgan Stanley. We believe that these proposals signal clear expectations that the banks should not only begin measuring and disclosing their financed emissions, but have to adopt Paris-aligned goals and plans to achieve those goals through reduced financing to carbon-intensive activities. Not in years or decades from now, but in the near term. As an example, we had a proposal this year filed with JP Morgan Chase. Was filed by As You Sow, but we have many co-filers along with us. So as you know, JP Morgan Chase is the largest funder of fossil fuels, and it was asked to issue a report answering if and how it intends to reduce its lending activities in alignment with the Paris goal. That framing is probably unique to the US, but if it intends to align is a very important question. And it really needs to be answered in a yes or no way to be so that investors are clear. Does it intend to become Paris aligned? And if so, what are the plans it has for doing so? Comparability between banks is increasingly important, especially as we see European banks starting to move in the right direction. Next slide, please. The supporting statement of that proposal outlines investor expectations, including measuring and disclosing finance emissions, setting a clear target aligned with Paris, and identifying how it plans to do so. What areas will be a priority in terms of its plans, and the timeline for implementing it. Next slide. So Wells Fargo, Bank of America, Goldman Sachs, and Morgan Stanley each agreed this year to undertake some form of assessing risk and or measuring their carbon footprints toward adoption of Paris-aligned goals. None has yet fully committed to adopt Paris goals, but we expect to see those goals expeditiously adopted. And as a result of these initial commitments, the resolutions with those banks were withdrawn this year. JP Morgan Chase was not willing to make any commitments beyond its announcement of limiting financing to some coal activities and Arctic projects. So the proposal against JP Morgan will go to a vote this year. I also included a proposal by Trillium Asset Management filed on behalf of the Oneida Nation of Wisconsin. And that asks JP Morgan Chase how it plans to respond to the reputational risks related to funding Canadian oil sand production and companies and Arctic oil and gas, both important issues to Native Americans whose lives in sacred areas are impacted by those activities. So that too will go to a vote this year, as far as I understand. Next slide. The first resolution at a European bank was also filed this year with Barclays. Barclays is the largest European financer of fossil fuels and the sixth largest globally. The resolution goes further than US proposals in that it asks the company to set and disclose targets to phase out the provision of all financial services, not phase out, but become Paris aligned, not just lending, which at this point, US proposals are focused on lending. The resolution asks the company, yes, to phase out its project finance, corporate finance, and underwriting activities that are not aligned with the Paris goal of well below 2 degrees, particularly to the energy and electric and gas utility sectors. The timelines for phase out also have to be aligned with Paris goals. Notably, the resolution was filed despite the fact that Barclays is a founding member of the Principles for Responsible Banking and has announced plans to end project finance for greenfield thermal coal mines and coal-fired power stations. Despite those commitments, including the joining principles for responsible banking, the company's financial activities with the oil and gas and utility sectors, among others, simply is not aligned with Paris goals. So it's not enough to just join groups or to adopt measurement techniques. Company policies have to follow, and they have to be at the scope and rate that's necessary to meet Paris targets. So I'll end with the fact that alignment with the Paris goals is critical to shareholders. An economy that's battered by climate change presents demonstrable harm to portfolios. I think there's a Citigroup report noting that failure to limit temperature rise to 1.5 degrees and continuation of a business as usual pathway may cost the global economy an extra 50 trillion in damages and lost productivity by 2060. Those are big numbers, and systemically this matters to shareholders, including certainly long-term shareholders, universal shareholders, pension funds, etc. We need an economy that is moving in the right direction. So I'll end my comments there. Thank you. And Lisa Lindsley, I'll turn it over to Lisa Lindsley of Majority Action.
Thank you, Danielle. My name's Lisa Lindsley. I'm from Majority Action, and we are a nonprofit that empowers shareholders to hold corporations accountable to the highest standards of corporate governance, social responsibility, and long-term value creation. Next slide, please. As Ivan mentioned in his presentation, one of the first step in terms of achieving the Paris Accords by corporations is making the high-level commitment to act. And while there have always been votes against specific board members at specific companies, there's a momentum building to adopt proxy voting policies that an increasing number of shareholders to vote against board members at companies that are failing to address climate change. Because of it, it's an existential, unmitigatable, and undiversifiable risk. So starting with Legal in General in 2017, and then continuing to Saracen, State Street, and then the votes against the Exxon board by New York State and the Church Commissioners of England, we're seeing more and more shareholders adopting this. And because target setting, the strategy, and the reporting alignment that climate change demands requires an entire transformation of a business that can only be overseen by the leadership of the board. So the likely response and recommendation in the 2021 proxy season will be to withhold on board chairs and lead independent directors at companies and fossil fuel intensive industries, as well as the banks that finance those industries, if they fail to commit to achieve net zero emissions by 2050. Next slide, please. Currently, shareholders are advocating a vote against the independent lead director of JP Morgan Chase. Jason did an excellent job of detailing the leading role of JP Morgan Chase in financing climate change. There's also this article from Bloomberg, as well as a Rolling Stone article from February 24th, if you'd like to check that out. And Majority Action also filed an exempt solicitation to this effect. Lee Raymond, who was the chair and CEO of ExxonMobil when Exxon developed its, became the architect of US corporate climate denialism, has been on the board of JP Morgan Chase for 33 years. He has served as the lead independent director overseeing Joint Chair CEO Jamie Dimon for the last 19 years. He is also the chair of the Compensation Committee and a member of the Governance and Nominating Committee. I think that as Jason's analysis highlights, the policies recently adopted by JP Morgan Chase are really a drop in the bucket and cover a tiny fraction. One quote I saw was 1% of JP Morgan's fossil fuel finance. we calculate that the total credit exposure that the bank has to the oil and gas industry last year was $41.5 billion, which is 22% of the bank's tangible common equity. And the current shock of the collapse of oil prices, as well as the COVID-19 virus, is really an indicator of the risks that are yet to come. So on the basis of tenure, on the basis of lack of independence, on the basis of his role in climate denialism and JP Morgan's outsized role in financing climate change, we believe there are many different reasons to vote against Lee Raymond. Next slide, please. So what's going on in this year? The vote against Lee Raymond, and there's a URL where you can go and announce in advance that you will vote against him. Many investors voted against him last year. In addition, the effort to have an independent board chair at JP Morgan, which has been ongoing since for many decades, is continuing this year. There's a proposal by Ken Steiner. There's the As You Sow proposal that Danielle just talked about, as well as the Trillium proposal that Danielle just described. So these are the votes coming up in 2020. Thank you.
And I wanted, this is Danielle, I did forget to also add at the end of my section that it's important that investors not only vote, they also individually talk to banks. So where they own banks, asking whether the banks are intending to become Paris aligned, whether they're measuring, and how quickly they're moving. Thanks.
Yeah, Danielle, I just wanted to say, I think there's some, I think Climate Safe Lending is also trying to coordinate those dialogues, but as well as ICCR. So I think there'll be more information about that.
So thank you all for your comments. Just really quickly to wrap up here, you heard on this presentation that there are several actions that are coming up in this year. And then there's also an interest in figuring out what it is that can be done to coordinate shareholder action and shareholder engagement going into the coming season 2021. To that end, Climate Safe Lending is proposing that we will be offering a series of learning webinars to do deep dives on some of these, the topics that were raised here on this call. That we would also be willing to engage those on this call and others in formal working groups to help facilitate that shareholder collaboration. And following this call, we will send out both the recording of this webinar as well as the slides, and a survey will be coming about how you would like to stay involved. At this point, I'm going to stop sharing, and I wanted to turn it over to anyone who may have questions. There was one question that came through in the very beginning that I wanted to just to bring back up to the group, was that many banks assert that they are already aligned with Paris goals. And so I wonder, perhaps Lauren and Danielle, you or others, if you want to jump in, is the question here is, what do you look for to affirm if a bank is aligned?
Hi, this is Lauren. I'll start first. One of them was whether or not there's actually explicit criteria in their risk assessment or sector level criteria around alignment in terms of 1.5 degrees or less. The other one would be looking at specifically RBS's policies that they've come out with, where they've talked about cutting financing to oil and gas companies by 2021, those without a Paris-aligned strategy. Similarly, looking at funding to coal, so those would be a couple of examples.
And I would add to that the IPCC has stated that we need to reach net zero by 2050. So does the bank state an intent to align its actions with those goals? Is it reducing its financed emissions? So it has a carbon footprint in the same as any other company. So is it reducing its financed emissions in line with that? And that means that there has to be a clear reduction over time in its financed emissions, that at a rate that's going to essentially bring it to net zero by 2050. So I think that is just a simple way to think about this.
And in fact,
this is Lisa Lindsley. I would just add that to the extent that a bank has an asset management arm, I would recommend that shareholders also look at the proxy voting policies of that asset management arm. And is the bank saying that it supports actions to curb climate change with one hand, and with the other hand voting against all efforts by shareholders to highlight those risks?
one of the things I wanted to highlight with the UK banks specifically is with the Bank of England coming out with new stress testing and the UK having a goal of net zero by 2050. The stress testing exercise that the Bank of England is undergoing right now is looking at Paris aligned, and will also potentially in the next kind of cycle, even have funding requirements for those that have more climate risk on their books than others.
One other thing just to add into this mix on the question of Paris alignment is connecting this to the no expansion discussion. So, potential emissions from the oil, gas, and coal that's already in production takes the world well past 2 degrees, let alone 1.5. And this is, there's a short essay on Paris alignment in the most recent edition of the Banking on Climate Change report. But from the climate movement point of view, expansion of fossil fuels is really a key litmus test for Paris alignment. For fossil fuel companies, and then for banks, the question is, are they being transparent about what they're requiring of clients, and are they requiring of clients that they not expand fossil fuels, that they not explore for new reserves, and so on. So I'd add that in addition to everything that's just been said about sort of overall climate impact alignment for the banks.
I mean, we have to see explicit decarbonization goals of their lending portfolios, and that's been a key focus for us, not only individually but also under the Climate Safe Lending network. And the reason why we have an overarching goal of Paris alignment by 2025 for European and U.S. banks.
So we have an additional question here, which is that, so banks also say that they don't know how to measure financed emissions, and that science-based targets frameworks not yet in place. Canadian Task Force recommends Scope 3 reporting, not even targets, by 2024. What do you give this any credence, or what other comments might you have about this?
I'll jump in quickly just to say, if fossil fuel financing is increasing, I would say that the banks are not Paris aligned. That's a very easy initial marker, because if carbon footprints are going up, it's a problem. I also would say too that clean financing is not, you can't say, well, I'm increasing clean financing while continuing to fund fossil fuel or increase fossil fuel lending or other activities, because those two don't cancel each other out. So long as the carbon footprint and financed activities, fossil fuel finance activities are growing, then you're not going in the right direction.
Yeah, this is Lauren. I would say that to the question of how to measure financed emissions, there are many banks now trialing measuring financed emissions, including PCAF. That's why we've actually joined that initiative. Science-based targets are coming out with a framework. CDP's own sector questionnaire for banks will be aligned on Scope 3 emissions. And we've actually seen some of the French banks and some of the European banks measure financed emissions. In fact, Credit Agricole, I think, has been one of the only banks who has done this across their lending portfolio. And you have banks like Natixis grading their financing from climate harmful to climate positive. They've come up with a whole color coding scheme, and many of the French regulators are looking at how more banks in France and elsewhere can adopt these kinds of financed admission assessments. But the gold standard is really science-based targets.
We are at time, and I want to thank you all for spending this hour with us. Just to wrap up, we will be sending out a survey after this call to many of you who registered, to all of you who registered, seeing how we can continue this work together, and the webinar and the presentation will be available as well. We wish you all the best in this very unusual time, and thank you for continuing your own efforts and focus on climate change, and the best to all of you and your families. Thank you so much.
Thanks, Erin.
Thanks, everyone.
Thanks, Erin.